What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Doordash stock, ticker DASH. The stock went IPO in December of 2020 at about $180 a share. It went all the way up to about $250 a share, and now we're down to only $45 a share. It's trading at a market cap of $17 billion, and Doordash is a famous company around the world in tons of different countries, because they are the number one player, I believe 60% market share in the United States, but they are the number one player in food delivery. They are an app and a website that allows people to deliver food or groceries. They also are partnered with, Walgreens and Jewel and stuff like that, but it's usually food, and they deliver it to people. Now, I think this is a great idea. I think this is a service that is needed in our society. The problem with it is I don't think the numbers line up too great. That's the problem, is because, for example, DoorDash can't make a profit, right? And they're doing billions of dollars of revenue at this point. I understand they are still a growth company, but I like to see a company make a profit when they're doing $5 billion in revenue. But really the point is that the drivers, although, because I used to work for this company for a couple of years, and although it's a pretty laid back, easy job, the problem is it doesn't pay great. Like a lot of the deliveries, you only get $3 or $5. Now, you don't have to accept those. I never did them for that cheap, but I'm saying some of the deliveries they give you are only for $3 or $5. Now, a lot are for $7 or $10 too, and then it's a little bit better. And every once in a while, I've gotten orders that are $20 or $30, especially if the person tips a lot. But the point is that doesn't line up too great for the delivery driver. And then for the customers aren't always happy with what they're paying either, because there's lots of fees. There's at least another like $7, $8 that you're going to pay in fees, not counting the tip, to get your DoorDash. So that's the other problem, is DoorDash can't make money. The customer's not happy with how much money they have to pay in fees. And then the DoorDash driver is also not always happy because they're not making too much money. So that's the problem. As a business model, it doesn't have great numbers to it. But I do believe it's a service that is going to stick around, and it's a service that people really want. So number one on the checklist, is the stock down? Yes, it's down a lot, 75%, 79% in the last year. And is revenue increasing? Yes. Revenue is increasing. They've done a good job with that, but net income is not. So revenue has gone from 291 million 4 years ago to now 4.9 billion in the last year. So that's phenomenal. They've done a great job there. However, if you look at earnings, it's gone from negative 200 million on the bottom line to negative 470 million on the bottom line last year. So it's really only getting worse. It's not like they shouldn't be doing too much. They're literally just a middleman with an app, so it shouldn't cost them that much money. But whatever, it is what it is. So net income's going to get a no. Then we get to forward price to sales. This I gave a yes, because I believe the price to sales on this, let's see, we can just run it really quick. So $17 billion is the market cap, and they're expected to do what? Let's say for this year, 6.4 billion, let's call it. So that's a forward price to sales of 2.6. That's pretty cheap for a company that's doing 30% revenue growth, and then next year expected to do 23. That's pretty good. Then we have price to earnings, no, because they're unprofitable. Is the company innovative, or do they have a moat? Yes, I believe this company is very innovative. Although they do have a competitor, they have different competitors like Instacart. They also have Uber Eats and stuff like that. I still think they are innovative for what they're doing, and they do have a moat because I think they have about 60% market share in the United States. So they do have some competitive advantages there. Number 7, is it a growing industry? Yes, absolutely. As we saw here, they're still growing revenue 30%, and they still have other countries to expand to. So I don't think that's going to be a problem for them. Now, how is the return on capital? This I gave a no, because once again, they're not profitable. They don't really make money on their investment. So right now, that's not looking too good. Same thing with margins. They don't have great margins. So that's a bit of a problem. Now, healthy cash flow, I gave a yes. It's not a phenomenal cash flow statement, but at the same time, they can at least prove that they are improving their cash flows. So if we look here, we can see operating cash flow has gone from what, 200 million? No, yeah, it was negative It was negative $500 million a couple years ago, and then they worked it up, and now they're up to $419 million of operating cash flow for the prior year. So that's good. End cash position is also in a pretty healthy spot, right around 2.7 billion, and free cash flow is positive. So pretty good overall. Then we get to diverse revenue streams. This can be interpreted different ways. I gave it a yes because they operate in so many different countries around the world, and because they do have, they probably have a billion customers, or at least a billion possible customers. It's not like if they lose a couple customers, it's going to kill the business. So they're doing good with that. Then we get to the balance sheet, and we look at the balance sheet. We can see that they do have more assets and liabilities. Specifically, the equity has gone from $500 million all the way up to 4.7 billion now, and actually, yeah, it's up to 7.4 billion in equity. So that's very good. They actually have a very good balance sheet for the size of the company that they are. Is the equity over 10% of the market cap? Yes. How we just saw 7 billion in equity, and this is a $17 billion company. That's very strong. Do they have a strong share buyback? No, unfortunately not. This is one of the weak points for the stock. 8% increase in the number of shares. So that's not good. That's just adding to the downward pressure for the stock. Are insiders interested? No. This is something I don't like to see. If we look here, we can see that less than 1% of the insiders own the company. That's not a make it or break it situation. Just because that's the case doesn't mean it's the company's going to fail, but it definitely is not a good sign. Under 1% of the shares are held by insiders. That's not ideal. Now, I don't know. You can interpret that different ways, but I don't like to see that. Next up is the company founder led? Do they have a good team? I put yes. They've definitely done a good job growing the company, and also the current CEO is a co-founder. So they could have just been people that founded the company, grew the company, sold it for billions of dollars, and then that's it. They just wanted to take the money, and that's it. But that's not always a good sign, because that means they don't have as much at stake for this company. They don't have the money invested into the company. So I don't think it looks too great there. Do they have more cash than their average earnings? Yes, because they have a ton of cash, but they don't earn anything. So that's fine there. Do they have a healthy dividend? No dividend. And are they over 20 years old? No, they were founded in 2013. So they're approaching just a 10 years of being a company. So all in all, this is 11 out of 19 for a score, which is going to be considered not a buy. Although it's considered not a buy, I can understand if you wanted to invest in this, just because I think this company is going to be the #1 player for years and years to go. So I don't think there's much to worry about there. I just would not be expecting much from their profitability. So thank you for watching Stock Talk with Nico Kritikos. Comment down below all of your thoughts, and I will see you in the next video.